Hello bulls and bears, JJ here. You're watching Bull Boom Bear Bust. It is Thursday, March 5th. Wow, another market open deep in the red. We're going to talk about that. All major indexes getting beat down here. This is major volatility, and that's one of the things we're going to talk about here. The stock volatility on Wall Street's the worst in 9 years. Investors, are they escaping the hard assets? We're going to take a look at some metal prices here. The repo markets are getting uglier. Yes, repo markets are oversubscribed once again, and the average repo bank bailout is getting higher. As we've been telling you, it's going to be like that. It's probably going to get worse because, see, if they ever pull back on the debt, then you finally start seeing the fake economy start to crumble, and they can't have that at this point. Finally, we have banks push for more leverage, less capital requirements. If it wasn't insane already with the fractional reserve system and the fact that we have already had this repo panic, well, it's about to get a lot worse as far as regulations go. So let's get into it. All right, back to the markets again. As you can see, deep in the red at the open. It doesn't mean they're going to end up in the red. We've seen wild intraday swings too, with huge 600, 700, 800 point swings from open to close, from green to red. So nobody knows where this is going to end up. But the volatility is the worst since 2011. Let's talk about that. And then right after this, we're going to talk about, will this volatility push more people into a more stable asset? For example, precious metals, not as volatile. Many investors are choosing to just sit it out on the sideline until the market finds a true direction. So far, it's been a lot of up days, a lot of down days. We're not seeing a true direction, an uptrend or a downtrend. Right now, remember, 2011, we were still coming out of the financial crisis. A lot of investors were still very skittish back then as the economy was trying to find its footing, so to speak, as it ultimately did with ultra low interest rates and loosening regulations of the bank, which allowed the debt to get back to where it was prior to the financial crisis, and now, of course, much higher and much worse than where we were at back then before that financial crisis imploded. So the volatility is getting wild, to say the least, and we're definitely going to have to keep our eye on this for you. Now let's just look at a 1 month chart here for the Dow Jones. You can see that we have still only recovered a fraction of the big sell-off that we had last week with the 5,000 plus point drop at that time. So we'll have to see if the pattern develops, higher highs and higher lows back into an uptrend. I think you all know my opinion by now. I think they're going to push this market back up, and I still predict, my prediction has not changed. Dow Jones 30,000, we almost hit it. We were within 400 points of 30,000. So my prediction that I've been putting out there for like a year, we were just about there, even with this crazy black swan event that's been unfolding here for a few months now. It still almost hit that target. And again, I would still say Dow Jones 30, 32,000 more likely before the end of the year. And who knows what other black swans are going to fly at us, but I'll still stick to that prediction. And of course, as always, nobody take my advice. Right? A lot of this is just analyzing charts and trying to tie it in with all of the political uncertainty that we're seeing right now. So a lot of moving parts to dissect. So of course, no one is recommended to take my advice, but do your own due diligence and use the information that we put out here to your advantage. Next, let's talk about hard assets. Are investors escaping to hard assets? Well, let's take a look. Let's just focus on gold in this video. Gold up nearly another 2%, holding at 1660. Now, sadly, the paper market is so manipulated for gold that even if a lot of investors are fleeing into gold, it is most likely that the price is still not really reflecting the true demand that we're seeing in gold right now. Let's just head over to a 1 year chart and take a look. Here we are, a true definition of an uptrend. Higher highs, higher lows. Of course, we did see this big dip back here, but as you can see, the uptrend is in play for gold. And imagine if the paper market manipulation wasn't here, what we would be seeing in gold prices. And also imagine if anything, as in the future, if anything is ever done on this paper market, futures market manipulation in gold, what could happen? We could see the price skyrocket overnight. if something like that were to happen. I'm not holding my breath because we're going to talk about something here in a few minutes that points to banks getting more power and less oversight. And unfortunately, I think it's also going to further unleash this manipulation that we're seeing in other commodities in this case. Next, let's talk about the banks getting even more, I would call it insane, but the bankers would just call it necessary. So the Fed is retooling capital rules for largest U.S. banks. So even though we're already in this fractional reserve banking system and we're having a repo crisis, they're not blaming it on loose lending. They're blaming it that the regulations are too tight. That's why there's a liquidity crisis, and that's why we need the repo bailouts. Now, speaking of repo bailouts, I was going to talk about that. Let's go over to New York Fed's website and see what happened today, March 5th, in the repo market. So we see the one-day repo right here, 87 billion. So not as big as the previous 2 days, but it's still in the upper end of what we've been seeing over the past few months. Okay, now that was the one day. Let's go down here to the 10 and the 14-day repo, and we see it was oversubscribed. So they allotted 20 billion out of 72 billion. If it would have been accepted, you would have saw another 72 billion here. Combine that with the 87 billion up here for this shorter term operation, and we would have witnessed about $150 billion repo day. That would have been the highest in the repo market bailouts that we've seen yet. Right, so it continues. Things are getting worse, not better. Banks are looking to deregulate, and here's how they described it over at Wall Street here in this article. Quote, Wall Street's biggest banks shamelessly try to use, let's call this the cerveza sickness, to get Federal Reserve to weaken rules, better markets. So it's not enough that banks have issued so much debt that they're having a repo crisis and a liquidity crisis. They're actually blaming the crisis now, the liquidity crisis, on the little regulations that are still left. And of course, before this, they blamed the cerveza sickness on the reason why they also needed to loosen regulations. Okay, I'm just going to read a quick excerpt out of this Wall Street Journal article. Fed officials on Wednesday said that changes would simplify rules for big banks such as JP Morgan Chase, Wells Fargo, without posing risk to the stability of the financial system. The overhaul simplifies the post-crisis capital framework for the banks while maintaining the strong capital requirements that are the hallmark of the framework. So the largest bank lobbying group in the U.S., the Bank Policy Institute, is leveraging the cerveza scare to pressure the Fed into relaxing these banking regulations. And it is these regulations that were imposed on banks to prevent another financial crisis or a replay of what we saw about 12 years ago now. And it has to do with the liquidity and the capital requirements. Now this group, this lobbying group, the BPI, the Bank Policy Institute, their board is comprised of bank CEOs, including CEOs of the 4 largest banks in the U.S. We have Jamie Dimon from Chase, Brian Moynihan from Bank of America, Michael Corbat of Citigroup, Charles Scharf of Wells Fargo, and they are not liking the current limits that are put on the banks. So folks, basically we have another disaster in the making. Again, the banking system has been heavily deregulated since the financial crisis. And you've probably heard the current administration out there basically bragging about it. Too many regulations, we're deregulating. It's clamping the growth of the economy. Right? What they mean by clamping the growth of the economy is they're clamping the growth of debt. The more regulations imposed on the banks means less debt than they can issue. But of course they're going to point to that as hindering quote-unquote growth. That way they can get more power, less regulations, and because they've been designated as too big to fail, guess who's going to bail them out? You and me, the middle class, the taxpayer. And ultimately, when we get some politician in there that's going to raise taxes on everybody to try to pay off this unpayable debt, it is unpayable, then you're going to see a complete wipeout of the middle class. I hope it doesn't happen, but that's the direction that we're headed in. based on what I can see. Hope I'm wrong, but you let me know what you think down in the comments, please. Like to hear from you. What do you think about this volatility, the big red days, the big green days in the stock market? What do you think about another oversubscribed repo day, repos averaging, getting higher? And finally, the banks pushing for more leverage and less capital requirements. Pretty sickening in my opinion, but really doesn't surprise me at all. If you've been watching this channel, none of this really should surprise you. This is the direction we're headed in, and we'll see if it all falls apart before the end of 2020. I kind of doubt it. But hey, that's just my analytical opinion. What is yours? Thank you very much. I'd like to hear from you. Bye for now.